This panel is going to try and be a little bit more inward looking at the financial services industry itself, which is experiencing some quite expansive views around new technologies and how that permeates the investment process. So I think we're all acutely aware that we're living through very interesting changing times to the buy side and the sell side. And the theme of this panel is creative disruption. So ultimately what we're trying to achieve from this very broad and diverse range of opinions is how does one survive and thrive in this? The way I think we'll kick this off, I'll ask each of the panelists maybe just to talk about themselves and their business briefly, and I'll include myself in that, and then we'll get into some Q&A. So where we kick off on the left hand.
Hi, I'm JP Smith. My firm is Ecstrat. I specialise in emerging market governance, corporate and sovereign governance. Been in the industry since 1983 as a Dwyer Analyst, European fund manager, emerging markets fund manager, and emerging market strategist on the sell side.
I've probably got one already. I'm Pelham Smithers. I run Pelham Smithers Associates, which is an Asian technology research firm. We basically do deep analysis into trends and individual products in coming out of Asia, especially Japan.
John Dwyer. I'm a capital markets fintech analyst at Celent, which is a division of Oliver Wyman. What I look at is the intersection of technology and regulation and how it impacts the financial services industry. So my clients are across every aspect of the value chain within capital markets. I've been looking at the emergence of new business models as a result of moving to research and bundling, but the core part of my narrative has been around emerging technologies such as blockchain, how that impacts the existing regulated financial services value chains, but also the emergence of new digital assets and ultimately an entirely new financial architecture.
So my name is Ryan Shea. I'm head of research at Amareos. We're a Hong Kong-based fintech company, and we specialize in generating crowdsourced sentiment indicators from automatically analyzing millions of daily financial articles. So we're attempting to ask, a question that most investors have, asked already, but they've just not been answering it in a very effective or efficient way. So we're trying to close that gap using technology. In terms of my background, I've been on the sell side, I've been on the buy side, and I'm an independent research provider, so I guess I'm a poacher turned gatekeeper turned landowner. Can't think of anything else to describe it.
Hi, I'm Cyrus Melawalla. I run CM Research. My background is PwC in Nomura, and I've run CM Research now for about 7 years. So what we do at CM is, while most sell-side analysts study stocks, we study themes, and we have a stock picking ecosystem based on algorithms around those themes to pick the stocks. We focus on the tech, media, and telecom sector. We cover 600 stocks globally and 50 themes, and we have this thematic engine with 30,000 metrics. So 50 themes times 600 stocks.
Right. Well, that sounds like a very good place and rich place to start. And so I think I'll start with you. So there's obviously an explosion of new tech in and around finance and capital markets. What is it that has really caught your eye as being potentially majorly disruptive from an asset management perspective?
I think the biggest factor for asset managers is, of course, AI, artificial intelligence. How is that going to impact their jobs, and are they going to have jobs? And I think the three areas that asset managers are going to be impacted the most are, first, as an investor, as an asset manager, they're going to pick companies that have an AI focus. So any CEO that reorganizes its company around AI is going to benefit. So in the same way that we use EV to EBITDA multiples as a valuation metric, they're going to use AI multiples to value companies higher. The second is investors themselves, asset managers themselves will rely more on AI, so they'll have robo-advisors, robo-research, and a lot of analysts will be made redundant. And the third is that the asset management industry will compete with the tech industry for AI talent. So many people say there's only 100 experts in deep learning. Deep learning is a type of machine learning, which is a type of AI where computers learn by themselves. It's used by high-frequency traders. And there's only 100 experts in artificial neural networks around the world, and banks and tech firms are competing for those experts.
Does that explosion in AI, so to speak, does that actually demand much greater use of old data? Is that kind of how alternative data sources of alpha, be it satellites or GPS or whatever it may be? Is that sort of a precursor to that?
Yeah, I think the complaint of many asset managers is that high frequency trading is now more than 50% of some markets, and high frequency trading it's not based on fundamentals or themes. It's based on algorithms, and those algorithms could be wrong, and therefore it's difficult to assess whether a stock is overbought or oversold. But there's a number of technologies that I think asset managers will be hit by. We've talked about AI, but there's also blockchain. Blockchain could impact the payment system. It could impact the settlement system, as it is for the Australian Securities Exchange. There's crowdfundings and initial coin offerings, or ICOs. So, equity capital markets could be kind of sidelined by these do-it-yourself mechanisms. There's cybersecurity. So I suspect we've all heard of the Equifax breach and what it's done to the Equifax share price. Well, next on the line is asset managers. So, as asset managers open their systems to online subscribers, they're going to get hacked as well, and a lot of asset managers who don't focus on cybersecurity are going to suffer for that. And then there's augmented reality. So just imagine the picture. We've always said for a long while that augmented reality, things like glasses, where you look at the real world, but you have artificial data, you have computer data generated on that. That's going to eventually replace the smartphone as your main digital interface to the internet. So picture a world where a retail, I'm walking down the street, I have a pension fund, I see a bit of news, and I use a bit of eye movement or gesture control to switch my fund from this fund to that fund just using my glasses. So that's the future of where fund management could go. Things are going to move faster, at much faster pace than we are already.
Right, maybe I'll shift.
I was just going to say, I hope they put a breathalyzer on those glasses. I'd hate to see what happened after a night out.
So AI, I mean, there seems to be a bull market in AI as well as many other things, and alt data, sentiment analysis is a key factor there. Can you help us understand what is the reality of AI with sentiment analytics? Is it something that's going to actually permeate the investment decision-making process and augment what the fund manager does? Is the end game that it will fully replace the fund manager? What's your sense based on where things are currently?
Well, the first thing I'd say about AI is actually there's a lot of BS. There really is. I mean, as you said, we can probably stick a hand up and confess to is that about the whole transition from effectively a carbon-based investment process to a silicon-based investment process. That transition is taking place. I don't think it's completely going to be eradicated. I think there's still jobs for humans. Hooray! Now we're partly responsible for that at Amareos. I mean, what we do is we analyze through our algorithms text. Now text is a horrible source to analyze. It's difficult to aggregate. It's difficult, just to pull it together in any meaningful way. You have to read it really, which is quite time consuming. If we can convert that through our algorithms and the application of AI into data, data is much easier to handle. We can aggregate it, we can analyze it, and that also means it's very coder friendly. Now, if it's coder friendly, that means it can be put into a process. So I think on that one we have to put our hands up and say, yes, we are definitely contributing to that transition. But it's not just about quants, and that's really what Amareos is all about, and that's why we produce research and not just provide data. We think this is applicable to a lot of people. If you actually think about what you're doing as an investor, one of the most profound questions you've got to answer is, what does everyone else think? Right? It doesn't matter what you think. That's a nice piece of information to have, but you need to know what everyone else thinks. Because if you can't answer that question properly, you can't make systematic alpha, you can't do good research, you can't make good market calls. Now think about how collectively or historically, how we arrive at that decision. We use polls. We analyze 2,000 people, representative sample, and we take their view as gospel. Well, it didn't work in Trump, it didn't work in Brexit. What else do? We can try and infer it from a market price, but again, US equity sentiment, is it through the roof, through the floor, in the middle? Now, if you looked at the price, what would you say? High, vol is low, everything looks rosy. We're probably on the greed side of the greed fear spectrum. But actually, when we look at our data, we don't see that at all. And we haven't seen that for a while, and that's why we've been bullish on equities, although I must admit, I'm personally getting a little bit nervous now because we've seen a transition, and we can ask and answer questions in a much more meaningful way. In terms of the cost savings, I think it's potentially huge. So our algorithms can shoot through, they do over 1 million articles every day, and we're getting up to 2 million. Now we've worked out how much reading time that equates to, and that's about 1,000 analysts a day sat down chewing all of this research and trying to understand it. Now 1,000 analysts, back of the envelope calculation, $20 million, $50 million, $100 million a year bill. Now we can replace that at a fraction of the cost. We give you better answers, and it's not just us, everyone can do it. I mean, as you say, we're using GPS satellites of Walmart car parks in order to get the same information. But we just need to change that mindset, and people need to embrace it. But it can be carbon as well as silver.
There was one fintech company that I know, and it's actually, I can't name it, but they developed quite an interesting natural language processing algorithm that analyzes text and voice. And as we know, if you're an analyst, I mean, I used to be an investment banker, I used to do a lot of webcasts and listen to corporates give their results. It was much easier to identify the changes in nuance in language and emphasis when you looked at the text and you looked at 3 or 4 quarters yourself, or you listened to 3 or 4 calls at once. And interestingly, they developed an NLP algorithm that can do that and identify changes in emphasis that perhaps indicate something more significant. And one of the data points, which is difficult to kind of pin down, but it does feel like with the prevalence of passive, when there is information given on these conference calls, the lack of active managers and frankly the influence of passive assets. So when you've got companies which have got very, very significant index fund ownership, perhaps the responsiveness of the market isn't quite what it should be. So it's an area of interest. But thank you for that. Maybe we'll just switch gears now to Japan. I was in Japan about 2 years ago doing a keynote on blockchain, and one of my colleagues was doing it on Robo, and it was the first time in my life I'd ever actually had a press conference when we got there, which was a bit of a surprise. But the traction that we got from banks and vendors around fintech was huge. I would say there was a slight deficit of understanding around blockchain at that point vis-a-vis the rest of the world, particularly the UK. That has definitely changed. I've also noticed in the interim period, the FSA in Japan has made fintech a strategic priority. Also, for a variety of reasons, good reasons, the Banking Reform Act has been changed, which gives much greater flexibility for Japanese banks to make investments into fintech. So it's a long intro to say, are we sort of going back to the future? Is Japan going to be an innovation hub now in technology that's relevant to our industry?
Well, I think in this area, definitely. There's a sort of wonderful misconception about Japan and technology because we all grew up in the 70s and 80s with Sony TVs and Toyota cars, and then they all fell behind. And then this Galapagos story, I think there is an element to it. When you go to Tokyo or live there, you realise it's a long way away from anywhere else. It takes 2 hours to fly from Tokyo to Seoul, and that's the next nearest sort of exciting place, really. It's 4 hours to Taipei, 6 hours to Hong Kong. It's a long way away. And this has all sorts of effects in terms of ability to keep up with consumer trends around the world. It's, if you don't visit these countries all the time, how do you know what's going on in, Dallas or Paris or whatever? And Japan just literally fell behind because it invented the mobile phone. It had a fantastic working mobile phone. Why on earth did it need a smartphone? But here's it works the other way around. Japan has an intriguing problem in finance. One problem is that Tokyo is probably the only major financial hub in which English is not a working language. You go to Frankfurt or you go to Hong Kong and you can do business in the local language, but if you don't speak the local language, you can get business done in English. You can't in Tokyo, so you have a linguistic problem. The second problem is you have this weird financial sector which is hugely underemployed for the huge amount of capital that exists in the country. So if you're running a bank, you cannot do mortgages because a mortgage the size of $100,000 is not going to cut it. You do not have the manpower. Anything under $10 million trade is really pointless. So you have this scale problem, you have this language problem, and suddenly fintech resolves both of those. Firstly, it enables you to catch up with the rest of the world in terms of providing the same services, because suddenly you can cut out all the linguistic problems, you can do all of the whole thing via software. The second solution is you no longer need people to do the transactions. The transactions can operate themselves. Consumers, intermediaries can do the transactions for you. And that's why blockchain in particular is really taking off in Japan. And it's really fascinating to see who's been at the forefront of this takeover. As you say, the change in regulations allowing Japanese banks to invest in fintech has just seen these guys say, thank God. And suddenly MUFJ, Mizuho, SMFG, companies that you would never think of being at the forefront of this are just racing into it and are putting certainly the UK to shame. And it was very funny when Boris Johnson turned up, gave one of his presentations to Tokyo and said, you guys have really got to catch up with fintech, look what we're doing in the UK. And they just looked at him and said, yeah, we were doing that 6 months ago.
And it's interesting, I mean, I know it's difficult not to have a conversation about Bitcoin at some point, but that has been made a legal payment mechanism in Japan. And there is, I understand, there's the sales app Regi by Recruit Holdings, which accesses 260,000 Japanese point of sale terminals, so you can integrate it very seamlessly into that market.
Yeah, I mean, when the Chinese put a sort of block on trading in Bitcoin in February, the yen Bitcoin trade became, I think, 75% of transactions overnight. I think now the dollar has taken over. I'm one of these people who think Bitcoin is more a source of transactions than a store of value or anything like that. And the reason for me that Bitcoin value rises is the more that you do transactions on Bitcoins, the more it gets stuck in the system. And so the finite amount of Bitcoin means that you have to pay up for it to get access, because more and more gets stuck in the system in little bits. So that's my personal explanation. And I think as a consequence of that, you could end up with a problem with Bitcoin getting up and up as the way. And that then begs the second question related to Japan. Having allowed Bitcoin, will they allow some of the other ones, the other cryptocurrencies, and which ones will they take? And I think that will be one of the most intriguing discussions to come out, because obviously everybody talks about Bitcoin as if it is the cryptocurrency. But in practice, it's just merely the first, and it's probably the weakest. And what comes next, in my view, is going to be a really indicative of both where Japan is going in fintech, but also where I think everybody else should start looking.
Yeah. I mean, I'll just give you a couple of stats. I mean, this is a market I've followed for years, and I'm long those assets. But the fundamental view on things like Bitcoin, there's a lot of issues around the scalability and so on. But the bottom line is, the question is there a global market for an alternative currency away from that which is run by, let's face it, the commercial banks who are systemically weak in part, and the central banks? And the answer is absolutely yes. I think the entire market capitalization of that entire complex is about 152 billion. NASDAQ at its peak in 2000 was 6.6 trillion, and that was pre the monetary policy largesse that we've seen in the past few years. So there's an enormous desire to institutionalize access to those assets, and it's got enormous implications for data sovereignty, which feeds into alt data and so on. So that is, it would be remiss to think that even if you don't believe in Bitcoin, that what is going on in the blockchain ecosystem is not important, because it's got dramatic implications for how data and monetization of data is going to happen, and it's going to ultimately rebalance the relationship between the data subject and the incumbent technology companies. So it's a significant area. So JP, governance, always an important part of any technology discussion. Post-08, there's obviously been a huge focus on regulatory governance and compliance and reg tech, and that's coincided with all of these technology opportunities. So as somebody who sort of studies long-term structural themes in finance, what do you kind of make of it in terms of how markets are evolving? Is there a regulatory technology trade-off? What perspectives could you share?
Good question, actually. I mean, on the technology side, I don't really have a lot to say other than to point out the bleeding obvious, which is that it's forcing costs down. It's over time. It's going to force fees down for intermediaries, and it's going to be another stage in the disintermediation of the markets. And one thing I'm not sure if it came up on the first panel is the question of the relationship between professional and amateur investors, and that barrier that at the moment that exists between the two, and the extent to which that barrier will be broken down, and how you cater for that. And obviously, I don't know what the view of the Smartkarma guys on this eventually is, but clearly, and you obviously have to be very careful with this, platforms like this that encourage some interaction, there's a sort of thin wedge, if you like, between something like this and some of the other apps that I've seen, which actually encourage amateur, if that's the right word, or non-professional investors to come on board. In fact, there's one app I've seen that in some ways resembles almost a sort of gambling app, and you can almost see actually investment, as some people already said, already is becoming a branch of the gaming industry, and that I think is potentially quite an interesting development. That's a slightly random observation. On the regulatory side, clearly what's been happening is that the regulators, because they want to focus on what's simple and what they believe is popular and what's politically desirable, is to force down fees, and all the emphasis has been on that, really without any thought or discussion about what some of the implications for that might be for the markets themselves. And as somebody rightly mentioned, we're seeing in Japan now, Japan is different to BOJ, I guess, that's buying the ETFs, but we're seeing this ETFization of the market. Now, I don't know what that means. I mean, in 2008, actually a good 20% before the bottom, I must say, I put my own money into S&P ETFs because the alternative was either to pay a lot of money to a long-only fund or to put money into a hedge fund. And of course, a hedge fund being the most expensive form of intermediation there is. But now the situation is very different. The markets are much higher, and there are all sorts of other liquidity issues as well as regulatory issues with the ETFs too. So that's clearly is an issue. And then on the data side of things, and this is a fairly banal observation, so forgive me, but there's this wonderful series, or wonderful is probably the wrong word given the subject matter on the Vietnam War at the moment. I don't know if any of you have been watching that, but you know, they had a section on Robert McNamara and his obsession with data, and in particular the body count. I think James Montier may have been, or perhaps it was Albert Edwards, wrote an essay on this a few years ago, and about this obsession with data that means that sometimes you tend to lose track of the context. And I think context is something that's very important, again, circling back, particularly if we're going to have more non-professional investors involved in the market more actively. Sorry, that was all very random.
No, that's helpful. Look, I don't know how we're doing for time. I mean, just kind of one last kind of question, which is observation is, you know, what does this mean for, you know, traditional asset managers? And we talked a lot about technology and a little bit about regulation, but for me, the process of integrating MiFID II compliance is really falling into three phases. The first one is, let's just get compliant. Nobody wants to be censured. The second one is going to be, I think, a reassessment next year on the basis of the enormous amounts of data that are going to come through as to what actually are these software solutions delivering in terms of alpha and competitive advantage. But I don't actually think we're going to really know anything about all of this until we have sustained volatility returning to the markets, because that's when the rubber hits the road with a lot of the passive vehicles and you know, a lot of the back testing of these algos. They've not really had the benefit of sustained volatility. So I don't know if there's any perspective there or.
Well, actually, it's quite interesting because in our pre-panel prep, which you're diverging from, you asked me the question about, you know, how is it doing, you know, human versus silicon, and I saw an interesting article on Bloomberg yesterday, and I had a look at returns of, you know, human stock pickers versus the algo funds, and as you say, the market's been very unusual, it's been very quiet, and yet the algos have done worse than the human stock pickers.
Mm.
Now, you would have expected the type of environment that we've got now is great for the algos. But so, you know, maybe there's a problem there, but maybe there's a broader problem as well, which is that, you know, what's the first lesson we taught as investors? Diversification. You know, we've got a lot of algos going in doing very similar things, and they're probably after a lot of that opportunity out. So I think there is, you know, the pendulum will swing back. You know, there is a role for humans. I mean, one of the questions we do get asked a lot is, you know, are humans still going to have a role to play in finance? And I think the answer is yes. Now, my sort of basic argument behind this is, well, you know, humans are the owners of capital. You know, we are endowed, thanks to evolution, with a load of psychological flaws. You know, we have to accept that. You know, there is no way that any human being, and I'd be interested if anyone's prepared to do this, I don't think any human being would be prepared to allocate all of their capital to an AI quant fund, an algo fund, that is run unaffected, without restriction, without human intervention. Anyone prepared to do that? I certainly am. And in fact, the interesting thing is there probably isn't even such a fund available, because all of the algo funds have human managers on them. So what happens when you get a disruptive market, or you get like a flash crash? You know what they do? They pull the plug, literally pull the plug. You know, the machines don't feel the financial pain, but the human managers do. So as long as the human people, as long as people are owning the capital, you know, we are always going to have a need for humans. That's it.
Can I just comment as well? I mean, you know, if you're talking about human judgment, I mean, you know, can a computer, can data tell you where there's moral hazard in the system? I mean, I think, you know, to me the answer to that is no. I mean, Petrobras, I think, had either 2 or 3 independent directors, right? And if you look on Bloomberg, you can see, and actually we look at Mark and I look at governance all the time, the companies, and you know, you can count the number of independent directors and quantify them for each company, but it doesn't really tell you anything, because it's a triumph of form over substance, and you could argue, and that's the whole ESG discussion, right? We don't really want to have here, but yes, human.
So there's still a role for humans. That's probably a good place to leave it. I think we're getting the pause. So thank you for your time and for your engagement. Thank you for your attention.